So hi guys, it's SJ speaking, and in this video we are going to see about candlesticks. I'm going to teach you about the basics of candlesticks. So the thing is, candlestick is one of the important topics in technical analysis. It is also a representation of price action. The candles, once the price moves, a candle is formed. Whether it moves upward or downward, a candle is formed, and this is formed because of the buyers and sellers. When coming to the candlesticks, so let's see the definition of candlesticks. So, what is a candlestick? It is a type of chart used in technical analysis to predict the price movements of a company's stock. They are said to have developed in the 18th century. So, this chart was developed by a Japanese rice trader who is known as Misa Hanma. So, he developed this in the around the 18th century. So, so I will show you the structure of the candlestick. So this is the basic structure of the candlestick. So there are two types of candles. So one is bull candle and another is bear candle. A bull candle is a upward movement candle. When the stock prices move upward, they form a bull candle. When there is demand for the stock, the candle moves. A bull candle is formed. When there is supply, when the sellers are high, a bear candle is formed. When the selling pressure is high, a bear candle is formed. So this is the basic structure of a candle. So what is a bull candle? A bull candle is where the stock's closing price is always greater than the open price. And a bear candle is where the stock's closing price is lesser than the open price. Suppose a stock is trading at 100 rupees. It opens at 100, but it closes at 102. This is known as a bull candle. If the stock price opens at around 100 rupees and closes at 98 rupees, let the low be 96 and 102, then the closing price is less than the open price. So this is known as a bear candle. The stock price is decreasing. So this is the structure. So you can see this is the open, this is the close, and this is the high, and this is the low. So the stock price opens at 100, is moves around 104, and it again comes down to 98 rupees, and finally it closes around 102. This is what happens. So what happens here is it can go here and go to the high and then close here, or it can go here and then come down and then close here. There are two scenarios. This is the scenario 1 and this is the scenario 2. This happens in a case of bearish candle. So suppose the stock price, let's take it as wait a minute, 1 minute, 1 minute. So suppose if the stock price is 100 and it closes around 96, its low is 96 and it's 102. It might happen the stock is opening here, it's going to the low and it comes to the high and it closes at 98 rupees. So this can happen. This is scenario 1. Scenario 2 is that the stock price opens here, goes to the high, goes to low, and then comes at close here. In both the scenarios, it closes at 98 rupees, but the variation, there is a variation. So there are two cases of scenario this might happen. So this is the bull candle and this is the bear candle. So a bull candle. So this is the body of the candle, which is also known as the real body, and this is these two lines, thin lines. These are known as wicks or shadows, or sometimes people may even call it as tails. So mostly people will call it as wicks or shadows. So this is known as upper wick and this is known as lower wick. And coming to the next, in this video, this is the first part of the candlesticks. I will bring some more videos to this candlesticks part 2 and part 3, maybe even part 4. So in this in this video, we will see about around 8 candles, basic 8 candles. So the first candle is hammer candle. So hammer is a bullish reversal candle, which indicates that the trend is bullish reversal, means that the trend is going to reverse from bearish to bullish. So this is known as a bullish trend reversal. So hammer candle usually forms around here or here or here. So the prior trend, the previous trend to a hammer candle will always be a bearish candle. Hammer will always form after a downtrend. It will form at the lowest point, at the swing low, at one of the swing lows. It will form. I've also brought some market structure videos. You can also watch that video. So you can watch which video suits you first. You can watch this and watch that, or you can watch that video first and come to this. You might get a good view. So this is what happens. Hammer always forms here or here or here. So this is the structure of the hammer candle. So the open is here and the close is equal to high if there is no upper shadow. But sometimes there can be a tiny upper shadow. So in that case, the close is not equal to the high, and this is the real body, and it has a long lower shadow. So usually the body is the wick is around two times, at least two times greater than the real body, length of the real body. But it is just a bookish kind of thing. Sometimes in the real market, if the wick is higher than the body, then we can consider it as a hammer. But if the as long as the wick is higher, then the reliability of the hammer candle increases. But it not always. You should not take it as the wick should be more than two times. Not like that. If even if the wick is slightly higher than the body, we can assume it as a hammer candle. You can see. So there are slight variations to this. The main focus is that the prior trend must be a downtrend. So sorry, yes, a prior trend must be a bearish trend. So this is the case, but the hammer candle is usually greenish. That is bullish candle, but it can also be a bearish red color candle. This is known as color relaxation. The only thing, irrespective of the color, whether it's red or green, whether it's a bullish candle or a bearish candle, you can consider it as a hammer if it forms below after a downtrend. So the thing is, what happens here is that because it is a demand-based candle, the demand, the buyers. So after the selling pressure is here, the hammer forms here. What happens is that the opening is done here, then the buyers push the price upward, but the sellers again push. Since the sellers are still in the market, the sellers push down, and again the buyers increase the price and close above the open. So this indicates that the buyers are entering into the market. The demand for the stock is increasing, and there are no sellers. The sellers are not that much. The supply is weak, and the demand is increasing. So this is how the hammer candle works. This is the concept of the. This is what happening in this scenario of the hammer candle. So this is it. So in this case, open, it might happen like this: open, high, low, and close, or open, low. It might happen. This is the scenario one, and this is the scenario two. This might happen like this. If a hammer candle occurs, whether it's a green candle or a red candle, if it occurs in an uptrend, then you should not take this. This is invalid. You should not take. You should only take it in a downtrend. This is the valid candle. You can take it here, or you can take it in a pullback, or you can take it here. So this is valid. So the thing is, another thing is where to take the entry. Entry should be taken once the if there is a previous support below. If there is a support here, then once the price breaks above the high, the next candle is formed. You can take the entry, and you can keep the stop loss around here, and you can keep your target yes here. I will show in the live chart, but here I will just show. If there is no support, then you can wait for another bullish candle, and then when the next candle opens up, or if it breaks the next candle's high, then you can take the entry. So this is how the entry is taken. So this is the hammer candle. So this is the example of a hammer candle. The color, irrespective, the color can be green or red, but usually hammer is considered as a red, green candle, but you can also take it as a red candle. So the prior trend is downtrend, and then a hammer is formed. You can take once the next candle breaks it high, you can take here if there is a previous support. If this is the new candle form, there is no previous support, then you can wait for the other candle to close above this candle, and then the next bullish candle you can take once the candle breaks above this open candle. You can take the entry here and keep the stop loss here, and you can keep your target here or here or here. Target 1, target 2, target 3, like that you can keep. So you should look for whether there is a previous support or not. If there is a support, you can take once the next candle breaks. If there is no support, you can wait for the next candle to close above this candle, and then you can take off. The next candle, you can see it as a bullish candle. So for the comfort or for a better reliability. So the next thing is here. This is also a hammer candle. You can take the entry, stop loss, target. And if there is no previous support, you can wait for this candle to close. You can take the entry here and keep your stop loss here, and then your target here. So this is the case. So next, coming to the shooting star. This is the opposite of the hammer. This is, of course, the opposite. This occurs in an uptrend. It occurs here, or it occurs here, or it occurs here. So, a shooting star candle is a bearish reversal candle, which indicates that the trend is going to reverse from bullish to bearish. So the structure is here. Open is here. The closing price is less than the open price. The high is here and the low is here. There is the long upper shadow, and there is tiny or no lower shadow. Usually the close is equal to low if there is no shadows, and if there is a tiny shadow, then the close is not equal to the low. What happens here is that, so there are two scenarios. So open, close, high, low. This is the first scenario. The second scenario is um, open, high, close. So this is the second scenario. So what happens here is the price is getting opened, and there is so the buyers are high and the stock price opens here, but it comes to a low here, and then it comes to the low, and then again the buyers are increasing, pushing the prices higher, but the sellers are coming into the market. The new sellers are entering into the market, and they're pushing the supply is high. There is no demand for the stock. There are no buyers. So the stock price coming, the seller is giving the prices, the stock price at lower prices. So the stock price comes down here and closes below the open price, and this is known as the and this is how this is what happens in a shooting star scenario. Before coming into that, so I need to say about this: what is bid price and what is ask price and what is spread. So bid price is the highest price that the buyer is willing to pay for a stock, and the ask price is the lowest price that the seller is willing to sell his stock. So if you go to a shop, then you are telling that this is the price that I would buy. Not, I will not pay more than this. Then that is the highest. That is the bid price of yours. That is your bidding price. And ask price, the shopkeeper tells that I will give this thing to you only at this price. I will not reduce more than this. Though this is the ask price of the seller. So the difference between the buying price and the selling price is known as spread. So this is what happens in the market too. So like auction, it happens. The supply and demand takes place, and that is what happens here. So this is the supply candle. There is no demand for the stock, and the stock falls below the open price. So this is what happens here. So I have given you an example here. So this is a shooting star looks. Irrespective of the colors, you can, if it happens, the prior trend must be an uptrend for the shooting star to form. So this happens here or here or here. It can happen. So in this case, that happened here. So you can also take this green candle, which is usually you can also take this as a shooting star irrespective. This is known as color relaxation, but usually many people consider that the shooting star is only a red candle, and if they see this candle is forming, they might just ignore it, but they are missing the opportunity. This is also a shooting star candle, even if it's the color is green, even if it's the bullish candle, it is a the prior trend is an uptrend. So this is also is considered as a shooting star candle. So entry should be taken here, and stop loss here, and exit here or here. This is the target 1 and this is the target 2. So you can take half of the profit here and another half here, or you can keep trailing stop losses. If you know what is the trailing stop loss, I will come into I'll say about the trailing stop loss in another video. So this is the case, but if there is no support, then you can wait for another bearish candle to finish, and you can take your entry here and keep your stop loss here and your target here, but the risk is higher, but you can get a confirmation that the stock price is going to come down. So in case if there is no resistance here, so in case of buying it's support, in case of resistance, in case of selling it's resistance. And I will bring a separate video for support and resistance. So this is the shooting star scenario. And next, coming to the inverted hammer. This is just the like this. When you keep the it's like a hammer. It's like an inverted piece of hammer. So this is the case here. This is a bullish reversal candle, which indicates that the trend is going to reverse from bearish to bullish. So this is the case. The open is here, and the high is here, and the low is here, and the close is here. So what happens here is that to open high, low, close. So this is what happens here. So what happens here is that the previous trend should be a downtrend. So this also happens. The inverted hammer should form here or here or here. So this is also similar to a hammer, only the structure is different. So what happens here? The buyers, the before the selling pressure is high, and now the buyers are entering. Then the buyers are entering, and then the buyers are pushing. But since the sellers are still in the market, they are pushing the price to the almost the same point as the low or a little bit down. So it might also be like this. And then but the buyers are coming into the market again, the demand for the stock is higher, and they close above the opening price. So this indicates that the trend is going to reverse. The buyers are coming in, the selling pressure is weak, the supply is becoming weak, and the demand is increasing. So this indicates that the trend is going to reverse, and this is what happens here. So example is here. So prior trend is a downtrend and the hammer forms here. It can also form here. It can also form here, and the trend goes like this. So this is the inverted hammer. There is a tiny shadow downwards. This is also a hammer. Irrespective of the color, you can take whether it's a green or bullish or bearish candle. You can take, but the prior trend must be a the previous trend must be a downtrend. So this is what happens. So the your entry should be here and your stop loss here, and your exit, your target can be here or here depending upon the market conditions. You can keep your target, and if there is no support here, you can wait for another candle to close. You can take your entry once bullish candle closes above here, or you can take it here and keep your stop loss here and target here. This is only for a confirmation. So aggressive traders usually take soon. So this is the case. Aggressive traders might not wait for the next candle. So conservative traders might wait, but you have to see whether there is a support previous or resistance. Only if there is support, you can take once the next candle breaks the high of the inverted hammer. Otherwise, you have to wait. Even if you're an aggressive trader, you have to wait for the next candle. So next candle is hanging man candle. So hanging man is a bearish reversal candle which indicates that the trend is going to reverse from bullish to bearish. This is just the opposite of the inverted hammer. It happens at an uptrend. So if you keep the shooting star in an inverted inverted side, then it's the hanging man. So it happens here or here or here. So it happens like this. The previous trend should be an uptrend. So the open is here, the close is here, the open is equal to high in case there is no upper shadow, or if there is a tiny upper shadow, then the open is not equal to high. So what happens here? The open, close, high, close. So open, low, high, close. This is what happens here. So what happens here is that the buying pressure is high, and then the sellers enter into the market and they push the price down, but still the buyers are there in the market, and they are high, and they are bringing the prices higher, and then the demand is weak, the supply becomes higher, and the sellers come into the market and they close the market below the opening price, which indicates that the selling is about to happen. The selling is about to start. The market is going to reverse from bullish to bearish. So this is what happens here. So the example. So irrespective of the color, you can the prior trend must be an uptrend. Then you can consider it as an hanging man. Irrespective of the color, you can consider it as a hanging man. In case of here, you can take the entry once the stock price, the next candle below breaks the low. In case if there is a support, if that in this case, if there is no support, you can take your entry here, or you can take a Fibonacci retracement, and you can wait for 50% retracement, and you can take an entry here and put your stop loss here and your target here. So here also you can take your entry over here and stop loss here and your target here. So entry, SL, and your target here. So based upon the support and resistance, you can use it as a confluence, and you can take an entry and exit orders. And this is what these four candles are also known as pin bar candles or umbrella candles. So there are various names, but you can always call it as a hammer, inverted hammer, hanging man, or a shooting star candle. So in the so hammer and inverted hammer always forms in sorry So hammer and inverted hammer always forms after a downtrend, whereas shooting star and hanging man always forms after an uptrend. So the next we are going to see about some indecision candles. So indecision candles are formed when there is intense battle between buyers and sellers. So this happens where the buyers are equal to the sellers. The buyers are equal to the sellers, or where there is low volume of trading. Where it happens in a sideways market, or it happens where the market is it happens in a sideways market, or it happens in a reversal point. It not only hammer and the pin bar candles are formed in reversals. The doji and these indecision candles can also form during a reversal. I will show you in an example. I will show you in examples. So this is the four price doji and doji star and long ledge doji. Here, usually trading doesn't take place. So or it might be like this. The open and close will be almost equal to each other. A little bit, very tiny, minute difference would be between the open and close price. Here, the open is usually equal to sorry, not open. The high and lows difference would be minute. Sorry, I told open and close. The high and lows difference would be minute. And here, the open is equal to the low, and the high is here, and the low is here, little much higher. And this takes it. It also has a longer wick. In this case of long ledge doji, the high is here, the low is here. Open and close are equal. This is the long ledge doji. And then coming to the spinning top, which happens usually at a reversal point. It happens usually at a reversal points. It happens, or it happens in a sideways market. So it happens around here. So dragonfly doji is similar to a hammer candle, and hammer or a hanging man candle, and a gravestone doji is similar to a shooting star or a inverted hammer candle. You should consider the same points which I said for those four candles. You should take in case of dragonfly and gravestone doji. The only difference is that in those candles it has a real body, but here there is not that much of a body. Only the open and close is almost equal to each other. So this is what, there is not much difference between those candles and this candle. So these are the examples. Before coming into that, I missed a point. So in this case of these candles, so only for reversals you have to take entry in these candles. So what I said, in case of hammer, you have to take an entry here. But what if the next candle breaks below the low? You should not take an entry here. This is an indication of the trend continuous. So this is an indication. If it moves opposite what it actually happens, you should not take an entry. This is a case of a trend continuation. You should not take entry here, or in case of hanging man, you should not take an entry here. This is a sign of trend continuation, but you should not take an entry here. These candles should be used only for trend reversals. So coming to the examples here. So here, this is a continuation. So spinning top can be used for both. Spinning top can be used for both upside movement and downside movements, but usually you take it as a reversal points. You use it. Beginners can use it only for reversals, but experts and experienced traders can also use the spinning top candles for trend continuation. They can even take an entry here and put the stop loss at low or below low. If it put exactly at low, then your stop loss would have hit here. If you had put some 2 or 3 points down, then you should have gotten a successful trade here, and your target around here. So this is the spinning top, and this is the doji, where the buyers are almost equal to sellers. This is the indecision candle, where there is not that much demand or supply, and this is a dragonfly doji, and this is the doji star, and this is a gravestone doji. So this, you can take it as these usually happen around some sideways market, where here this is sideways market. It can even happen in a reversal points. If you had taken a trade here and put your stop loss target here, then you would have been successful. If you put a target here, then you would have gotten losses. So you should consider the support and resistances also in confluences. So now I'll be showing these the candles in the real chart. So let's go into the real chart. So these are the 8 candles. Now we'll be going to into the real. Okay. So this is the examples, real time example. Um, Here you can see that the prior trend is a uptrend. So prior trend is an uptrend. So the market goes like this, and the candle is formed here, and then the trend comes down. You see here, this is the structure. So this is the structure of the market, and uh, the this is known as the shooting star. The red color bearish candle. This is known as the shooting star. The only candles which can form after a uptrend is shooting star or a hanging man. In this case, this is a shooting star. You can take your entry here. So you can take your entry here and put your stop loss here and put your target here, first target here, second target here, and you can trade. So this is there is no support, previous support here. So you should wait for a next candle, next bearish candle, or at least the next candle to close below this low. Even if it is a bullish candle, if it closes below here, you the most probably look for a bearish candle. So there is, since there is no resistance above here, so you can take here as entry point and your stop loss here and your target here. So this is a confirmation. So you can also take it here, but it's a risk. So since there is no resistance, you should take here after a bearish candle is closes below the low of the shooting star candle. So you can take your entry here and your stop loss here and your target here. So the shooting star is also formed here. You see, this is also a shooting star. This is also a big shooting star. You can take your entry here and stop loss here. So it is a 1:1 reward ratio. You see, you can take a short position here. In this case, you might get how much? You see, 1:1, almost 1:1. But here you can see, if you take it here, you take your entry point here, and keep your stop loss here, and your target here. You might get almost how you should keep the risk and reward ratio. Scalpers usually use 1:1, but a normal trader, intraday trader, or a swing trader or a positional trader, a normal trader should use one minimum 1:1.50. Then that is the good trade. Or you can use an ideal trade of 1:2, which is a good trade. Don't use less than this. 1:1.5 don't use. Only if you are a scalper, you can use 1.1. Other than that, you should not use 1:1. Some traders use take risk higher and they take targets less. This is a bad thing for a trader. You should not take trades such as this. And another example is here. You can see this is also a this is also a this is also a you should not consider it as a inverted hammer. This is a shooting star because the prior trend, since it is a green color candle, although it's a green candle, you should not consider it as a inverted hammer. This is a shooting star. You can see the risk to reward ratio. Once you can take an entry here after a bearish candle is here and your stop loss. Almost it has given a maximum of around 1:6. 0.66 ratio to 6.5, around 6.5 it has given. So this is one of the things. This is how you should keep your risk to reward. So another example is so see spinning top is formed here, spinning top is formed here. So next example is here that I will show you. So this is also a shooting star and this is also a shooting star and this is a hammer. You see a hammer is formed here. The prior trend is, of course, the prior trend is a downtrend and then it forms at a pullback. This is a pullback hammer. And you can take your risk to reward like this. You see here, risk to reward ratio. You can keep it as this much 1:2. The 2 is the minimum risk to reward, or 1:3. You can use it 1:3. Okay, 1:3. or you can wait for a confirmation for another bullish candle and you can keep your risk to reward ratio as 1 is to 2. You can also use look for the support and resistance. In this case, there is a support. So definitely you can take at this point itself. There is a support here. You can see here there is a support here. There is a support here. So you can take at this once the next candle, bullish candle breaks above this high of the hammer, you can take and your maximum it has given you a target of 1 is to 10. So, but you can always come in 1 is to 5 or 1 is to 4. You can take according to the, you can take even targets based upon the market structure. You can keep the swing high of the previous resistance. You can keep it as target. So, previous resistance you can take. So, this is the hammer, and this is again, and this is the shooting star again, and this is the spinning top candle here. A spinning top also forms at the reversal point. So spinning top candle is here. You can keep your risk to reward ratio again as this. So this is your risk to reward ratio. So minimum. Okay, you can keep it as this. So this is how you trade. You see, in this case, this is a red candle, but you can also consider this as a hammer because the prior trend is a downtrend. So coming to the next example is that, you see, we have seen about shooting star and hammer, but here is the inverted hammer. You see, the prior trend is, of course, a downtrend, but still, the it's a pullback. It's a pullback hanging man. In this case, you can take it as an entry. This is a hanging man, and you can bring the another thing is that you can take. You see, the hammer can happen. These candles. This is more important. This is the swing high. You have to take the spin bar candles at the most swing low or the most swing high points. It should be has this. This is the strong reliability of these candles. It can also form as like this, but this is unreliable since the this is not the most swing low. The hammer or a inverted hammer or a shooting star should form the most swing high, though, which gives you a high reliability. It can also form like this, but this is less reliable. Since this is not the most swing high, the candle should form at the most swing high point. So this is it. So okay, this is one thing you have to take into account. And coming back to the examples, so this is the inverted hammer where you can take your entry here and your stop loss here and your target around this swing low, or you can take it even around this swing low. You can use structures, support and resistances, or Fibonacci targets. I will put separate videos for those things. And then coming to the another example is here. See, there are more examples of inverted hammers. See, inverted hammer. Prior trend is an you see prior trend is a uptrend inverted hammer, and then see spinning top here. Spinning tops. You see inverted hammer again. You see in this here there are spinning top candle is here, and the next candle is hammer, and the next candle is inverted hammer. But the spinning top and the hammer has failed. Only the inverted hammer has been successful. If you have taken an entry based upon the hammer candle, you would have taken a loss. But if you have taken an entry based upon the inverted hammer, you would have taken a profit. You see, the risk to reward ratio is here. So wait for the next bullish candle since there is no previous support, but there is a previous support here. But if you are conservative, if you are not yet if you are a conservative trader, you can keep your entry and targets as here like this. You can keep your thing. So these are the examples of these candles, and coming into that, I can also show you spinning tops also can be used for reversals. So spinning top is a reversal candle, but it's a indecision candle, but indecision candle usually indecision candles are formed at sideways market or at a reversal points. You see, it is formed at a reversal pullback. So you can also use it, the reversal candle, and you can take your entries based upon this candle too. So it is usually known as the evening star kind of thing, which I will come into you. I will show you what is an evening star and morning star in my next part of the candlesticks video. So you can take your targets like this. So entry, stop loss, target. So entry here, stop loss here, target here. So these are the examples. And coming to the indecision candles. So these are the indecision candles. Mostly dojis, long time dojis, gravestone dojis, and dragonstone dojis are formed in a sideways market. You see, this is the sideways market. You see, wait. So this is the sideways market. You see, many dojis are formed here. Dragonstone dojis. In this case, this is the dragonstone doji. Sorry, this is the dragonfly doji, and where is the gravestone doji? This is the gravestone doji, and here is the long-legged doji, and this is the long-legged doji. This is the normal doji. So many are formed here. Even you see what I told. These are the places where the doji occurs. So this is what the candlesticks are about. This is how these are the basics candles which are used by most of the traders, and this is how you can use the candlesticks along with the market structure as a confluence, and you can take your entry orders, your buying or selling orders. So this is what my video is about. My video has come to an end, and what we saw is a brief summary of what we saw is candlesticks, the definition of it, who introduced it. So Japanese people introduced it, and this is the structure: bull candle, bear candle. This is the hammer candle, shooting star, inverted hammer, hanging man. These candles are also known as umbrella candles or pin bar candles. And then coming to the indecision candle, floor price doji, doji star, and um, then long ledge doji, and then coming to the spinning top, and then coming to the dragonfly doji, and then the gravestone doji. So usually spinning tops and forms at reversal points similar to the hammer and inverted hammer candles, spin bar candles. Spinning top usually forms at where there is high chances of reversal. So this is where the major decisions are taken. The market's decisions are taken by the buyers and sellers, whether to bring the market, reverse the market, or it can even also, the trend can also even continue after a spinning top is formed. But mostly beginners usually take only at reversal points. Don't take a trend continuous. Don't take orders at trend continuous, because these are the candles which are mostly used at reversal points by most of the traders. They become invalid when they are used for trend continuation. But sometimes even at trend continuation, they might be successful. But usually don't take it. Um, that's what my suggestion would be to you. So this video is enough for now. It took around 40 minutes, I think so. I don't know what's the time now. So usually you would have gotten a clear clarification of what candlesticks are. So this is what the candlesticks is about. So hope you guys enjoyed my videos. So give a like, share, and subscribe my channel. And also press the bell icon for and press the all button for getting notified for my future educational videos. And apart from that, I'm also taking personal mentorship trading courses. If you want to join my trading course, you can call me at my number in the scrolling on my video. I will give you the details. It will be online class. So I'll give you the details of my trading course. And of course, other than that, if you want to open a Demat account, you can visit my link given in the video description in all my videos. I've given you Zerodha link. You only need PAN card and Aadhaar card for opening the account. You can start your trading and investment from today onwards. And thank you guys. Share with your friends and families. It takes a lot of effort for these videos, and I need your support. So thank you guys. let me visit you on my next video. So until then, bye bye. Take care, guys.